Have you ever looked at your business profits and thought, where the hell is all my money going? Most business owners would immediately start to think about cutting costs, when in fact, they should be looking at their sales and ways to improve their margins. As a director of an accounting and business advisory firm, I've helped thousands of business owners improve their cash flow, increase their profits, and even save their business from going under. In this deep dive, I go through how to pay less tax through effective tax planning and structuring, how to streamline your processes to run a more efficient business, and how to charge what you're worth through value-based pricing. Let's dive right in. There are three strategies I mainly focus on. The first strategy, it's minimizing tax and structuring your business. The second strategy is to fix up your operations and processes, so to make them more efficient. And the third strategy is pricing. So what you need to do is actually look at increasing your prices or figuring out a way to actually get the right price for your business so you can actually generate the income that you need to make. Sometimes businesses, they start a business that priced way too low because they look at their customers and what they're charging, and then they just charge against that. They charge something similar. I think that style doesn't work, because if you look at most industries, every industry has a big range of prices. Same with me. You can go to the local business and you can get a tax return for $80. You know, the shopping centers, you can get one for like $80 to $100. We charge $300 for a personal tax return. And we've realized that because we spend a lot more time doing our tax returns, and we also pay our team members a lot more than, you know, the local accountant, that pricing model doesn't really work. So we've decided that we've actually stopped doing personal tax returns for our clients in a sense of like standalone tax returns. So if a person comes from the street, asks us, hey, I want to get my personal tax return done, we basically say, no, we can't do it anymore. All right, so tax strategies and structuring. You may have seen these structuring in one of the videos that I've done online, but this is the structure for most business owners and what I offer to them. So there are 4 different structures. Structure 1 is a sole trader. Sole trader is amazing for your business if you're just starting off. So if you're testing out the business and you think that you don't actually know how much income you're going to make, you can start off as a sole trader for the time being. And that's in your personal name. You set up an ABN. The tax required to pay for that is anywhere between 0 to 47%. If your personal income is quite low because you're not working for anyone and you're doing this full time, you might want to start as a sole trader. But if you have income on the side where you're working for someone and you're generating this side hustle income, and say that your income on the side, which is your wages, is over 150K, that means that you're close to the highest tax bracket. So sole trader may not work for you. You might want to set up a company or a trust, or a hybrid structure where you have a trust as well as a trading company. The benefits of having a trading company is that you can tax yourself at 25% rather than like the highest tax bracket at 47% as a sole trader. So structuring is really important. It's something that most business owners don't do. So the simple question you need to ask yourself is, are you legally paying more tax than you actually need? Most business owners focus on how much money they're making, and they don't actually think about what ways to reduce the taxes until it's too late. And when they go see their accountant, which is once a year, they find out they've got 30, 40% or half their profit that they've made. It needs to go to the tax office, and they never left enough money to do that. So that's one thing that will reduce their profits at the end of the day. And a lot of people just think that money in their bank account is what their profit is. And that's a serious issue that a lot of first-time business owners think, because that's how it works when it comes to your wages when you first start off. If the tax is already taken out, so when you get your wages paid to you from day one, say you were a first-time employee, 16 years old, when the money goes into your bank account, the tax has been taken out, the superannuation is taken out. But as a business owner, the super and the taxes has not been paid yet. So the money that hits your bank account, the normal habit for a normal person would be, that's my profit, I can spend it the way I want. And so they go and spend all the money. At the end of the financial year, they might have $50,000 in their bank account, and they go, all right, well, I have $50,000 in my bank account, then I just need to take away the tax and I'm good.
But that's not how taxes work. Taxes means that the money that hits your bank account, you firstly need to take the tax out and the superannuation out. The ATO relies on you to make that decision. If you don't do it right, then as a result of that, they would tax you a lot more, and you would have spent all that money, and then you've got cash flow issues, and that's what brings down the business as well. So structuring is a really good idea, but also making sure that you allow for taxes. So one thing I also want to show you guys is that because it's 30th of June in the end of financial year, I know some of you guys would have had like tax planning strategy meetings with my team or myself. I just want to quickly go over the different types of tax strategies that you can go through. There's an article I wrote down a while back. Vance, yeah, I wrote this in 2024. And it goes through the different types of tax strategies that you can minimize before 30th of June. So tax planning should be done before 30th of June. And what you can do is prepay expenses. So one thing that a lot of accountants don't advise out, well, I wouldn't say a lot of accountants, like a lot of business owners don't really do, is they don't speak to their accountants early enough. So they don't speak to them before 30th of June. And as a result of that, you lose the ability to spend money to reduce your taxes or increase your income because you want to pay more taxes to show a higher profit. So you lose the ability to do that because once 30th of June goes past, you can't, spend money anymore. You can't change the numbers. The numbers get locked in, and that's pretty much what your number's going to be for the rest of for that financial year. And you may need to pay more taxes to get the loans that you want or to show the profits you need for many reasons. So that's why it's really important to speak to an accountant. And here's a handy end of financial year tax tips that you can also go through in the articles. Basically, the ways to minimize your tax is to either reduce your profit, move your profit into another structure, which has a lower tax bracket. So for example, sole trader to company, 47% tax in your sole trader, 25% tax in your company. That's taking consideration the sole trader is in the highest tax bracket already. So you can automatically reduce your taxes by close to 25%, close to 20 to 25% just by moving to a trading company. What you could also do is even put money into super. So there's a super fund here that you can do. It doesn't have to be SMSF, but SMSF and a superannuation fund gets taxed at 15%. So increasing your super contributions will allow you to get taxed at 15% for the money that you put into super. And whereas compared to leaving the money in your personal name or leaving it in the company at 25 to 47%. So there are ways that you can minimize the tax by changing your structure. The second way is to reduce your income. Not many people like to reduce their income, but there is a legal way to reduce your income. And a legal way of reducing your income is planning before 30th of June going, all right, well, I could do this job. Right now, it's May 2025. I could start the job right now in June and invoice a first installment for my client, which could be $50,000 or $20,000, or I can wait till July and then start that job. If I wait till July, that means the income gets invoiced in July, which is the next financial year rather than this financial year. So that's ways that you can play with your income to minimize your tax. So you're not technically saying that you're going to reduce your income. You're just delaying your income to the next financial year. And as a result, your tax is lower. Okay. The opposite can happen as well, where you can actually bring forward income as well. So you decide that, you know what, I'm going to invoice for the work that I'm going to do in July, but I might as well invoice the first installment now. That income hits the bank account. That can be treated as income. As a result, you pay taxes on that. Then your profit goes up. So there are ways to minimize and increase your taxes, which as a result would increase your profit. The last method of tax planning is reducing your profits by increasing expenses. So that's like paying super, prepaying expenses that you think you're going to pay anyway. So a lot of businesses have these type of expenses that they always constantly paying on a monthly basis or maybe even an annual basis. They could bring forward some of these expenses. So say you do your insurances in August. You can call up your insurance company and say, hey, I want to renew my insurances now. and I want to pay for the next year and a half. If you do that, technically you can actually pay for your insurance earlier before 30th of June because you know you're going to pay for it anyway. And that means that if, say, your insurance is $5,000, you can actually minimize your tax and your profit by doing that. So yeah, there are things that you can do. Business travel is a big one as well. You know that you're going to travel for work or, for business or whatever, then, pay for the ticket now rather than later on down the track. It's claimable. There's other things as well. You can check it out. But yeah, tax planning, advanced end of financial year tax planning is an article that we read up 2024, I believe it was. But it still applies to today's date. So that's the different things you can do with your taxes. Obviously, writing off debt is another way, which means that you're increasing your expenses. Does anyone have any questions about tax planning before I jump on to the next strategy?
Sorry, Davie, just a quick one.
Yeah, sure.
So that's just moving your tax expense or reducing it for one financial year, but in the next financial year, you would still have to pay it, right? So it's also shifting by years. Yeah. Okay.
Yeah, so it's shifting. Some people then say to me that, like, what's the point? You're still going to pay the taxes anyway. I used to think that too when I was a junior accountant. I just didn't understand the point of doing that. And then I realized it's the power of compounding investments. The reason why Warren Buffett is making so much money is he knows he's going to make money, but he's going to play the long game. And the long game is, getting the rate of return to compoundly make more money for you. So if you make $100 now, that $100 now, and you make that $100 every single day for the next, 20 years, that $100 isn't going to be like a return on investment on $100 per day. That $100 one day would turn into $110 and it will go to $120. And because it's getting compoundly reinvested, it would end up doubling in a matter of like 5 to 10 years. So that's the same concept of paying less taxes now. So if you started off with, say, $100 that you get to pay yourself and you reinvest that money, you'll make more money by reinvesting, starting off with $100 rather than $60 instead. Because say that you're paying taxes early, the best explanation of this is just like drawing it out. And then
in my mindset, it's more so like, you're deferring taxes, so like you have more working capital. Yep. But in order to defer those taxes, you're still making payments out of your cash account. But yeah, it was just good to see your thoughts on it.
Yeah. So for example, this is, say that if your profit was this, and then your taxes is this at 47%. Say like you paid it to yourself. Say you're already on the highest tax bracket and you paid yourself that $250K as a dividend, or just like a profit share or a bonus to yourself, you would have to pay 47% on top because you're on the highest tax bracket already. And as a result of that, you only really have $132,000. But say that, and that's in your personal name, all right? But say that you didn't pay that tax and instead left that money in the company and then reinvested it, you would have 250, but that times 25%, and you're left with this much money in the company. So with that money, you've made essentially, you still have you have extra 55 grand. Okay. With that 55 grand now, I have the choice to go and hire someone with that, because that there is enough to pay for, someone's wages for 6 months, someone skilled for 6 months. So I can just go and hire that person and generate and then pay $9,000 a month. And hopefully that person would then try to bring in 3 times to 5 times their income that they pay to me. So from that $55,000 that I'm reinvesting, which I'm going to reinvest for 6 months, hopefully it will make me eventually 3 times that amount. And that person might not make 3 times straight away. It might take him 3 months or 6 months to start making 3 times that value. And say that he starts making it after 6 months, I'm now generating a profit on that return. Yeah. And that's how I see the power of it. Like, and no one ever talks about this. It's just like, it's crazy that like you should try to minimize your taxes as much as you can. And once you've made all the profit, pay the taxes, pay the 47%. But by then, the 47% would be already taxed at 25%. You would get a credit because everyone knows about the franking credits that we're talking about. You've already paid 25% on that 60, on that 250. So when you start drawing that money out and slowly making that, paying it to yourself, you will pay the 47% tax, but it would be that minus 47 here because you've already paid for 25 here. So you're only really paying 22% on the extra dollar that you're taking out now of the company. But that extra dollar is going to be like multiplied by because of compounding growth. Yeah. Make sense?
Yeah, it makes sense. Like
Yeah.
assuming that like you have the cash flow and the working capital, it just makes sense to do it.
Yeah.
Yeah, cool.
But you have to trust yourself as well. Like as a business owner, you could lose it all as well, right? It's a risk that and gamble that you have to make. But usually, a lot of business owners, they do the opposite. They just go and, well, not the opposite. They just go and borrow the money. And I see borrowing money and leveraging the money is a good idea as well. But you gotta understand that when you borrow the money, you gotta look at the interest rate that you're paying as well. So say that this $55,000, you're borrowing off the taxes that you have to pay. You just haven't paid the taxes yet. So the alternative is you go to the bank and you borrow that money and you pay 10% interest. So you're paying an extra month. You might as well just delay your income or your taxes, and you get a kind of like an interest-free loan. That's how I see it. Yeah. All right. So that's the main thing in terms of your taxes. The second strategy is like operational process and efficiency. So let's just say your sales stay exactly the same this year compared to next year. All right. And could you still grow your profit? So let's just say that if you made $3 million last year, and you just kept everything the same, and your income never increased, the answer is actually yes, you can actually still grow your profit because I've actually done that. So I just want to show you guys a P&L that I have, but I've got a P&L here that I've created. Obviously, I've manipulated it a bit, played around with it and all that stuff like that. These numbers are just like again, it's not like a true numbers, but close enough. But this is the income that, like, a business that I created, which is kind of like my business, that you can see the growth of my business. So I started off like about 2018. I actually started in 2016 is when I first started my business. But the first 2 years of my business, I was playing around, going on holidays and just taking a break from my career. So I made about like 100 and something K per year just to cover my wages. And then when I first started, when I started taking it more seriously is when it was in 2018. So you'll see that my business has grown significantly since then, but it's tapered off. This is the growth, 59%, 60%, 81%, and then it's dropped off 60%, 46% growth, and then 30%. And then in 2025, you'll see that the growth is actually only being like 5 or 10%. It's actually like I've already done. We did some tax manager planning day, and we've estimated that the growth is going to be like our income is going to be this. So that means that our profit is actually 7% growth. Crazy, right? So I posted this online like a while back, and the first comment was like, "There's something wrong with the business," because like there's no growth. Okay, and I said to them that you don't have the whole picture. Basically, what's happening within this business is that I've grown so fast in the last 3 or 4 years that there was so many issues with my business when I was growing. I was just so focused on looking after clients that there were like expenses I was paying for that were expenses I shouldn't be paying for. There were team members that weren't getting trained properly, so they were doing things and that took them longer. They would take twice as long to do the job. There were softwares that I had that probably useless, or even just the way I was collecting money was done incorrectly. For example, I send the invoice to a client. I'll wait 60 days for it to get paid when I should really try to get the money as quick as possible. So when your business grows, it goes through waves. There are stages in your business, and it's okay for you to, make less money or not grow at all. As long as you have a key goal and key plan in your business and you're working towards that, it's okay. So it did make me feel a bit down that my income has dropped. But if you look at my profit, you'll see that it's gone up. So this is net profit based on turnover sales. This is the net profit that I made. Okay, again, like I said, these numbers are manipulated based on like, I did change a few things and removed a few things of my expenses that were probably didn't really help the scenario. So just wanted to tell you guys that. But like, see how as my business grew, like you could see that the profit's gone up a bit, even though my turnover was going higher. But over time, you could see it start tapering off where my net profit started to reduce. And the reason why my net profit started to reduce is over time, like the processes, systems you create for a $1 million business does not work for a $3 million business. So you need to change those processes, but it takes trial and error to figure those things out. And for me, it took me like 2 years to realize that maybe I need to train my managers, because my managers were great. They were really good technicians. They're really good at what they were doing in doing tax returns. But when it came to managing a team, training the people that came in that have no experience in accounting, they were not good at it, because they were just really good at doing the work, not very good at talking to clients, not very good with training the team members, and working in unison with each other. So we had to fail a bit in terms of like growth. We had to slow down the growth to focus on actual the business itself. So let me give you an example of something I've done. So this is a business process, and I drew this business process back in 2017, and I drew it for a client. I said to a client, the client said to me, Davie, I don't know what's going on. I'm making so much money in my business, but there's no profit at the end of the day. Why is there no profit? And we sat down together for a day, and we drew out this type of like process flowchart. And this is a business that was in the construction industry. What happens is there is a purchase order, or there's a quote, or there's a customer that comes in and says, hey, I want you to do this for me. They already have a relationship with the second tier or first tier customer, and that client has sent over a purchase order. They already know all the pricing and all that stuff. The project managers reviews the job, and then plans and schedules the job, and then sends it out to the contractors to do the work. The contractors or employees, and the contractors and employees will go and do the work, and there may be variations, and it goes through this whole process again. And then it goes, once the job's completed, they send in this case, the employee or the contractor is the one that generates the invoice and sends it over to accounts. So this is for their fees, and for the contractor's fees, and the PM would approve the amount, and then the accounts would generate an invoice, for example, and then send it over to the project managers. Project managers will check it, and then our clients will then create. I think the project managers are sending the invoice, or the accounts team sending an invoice to the clients. Clients get the invoice, they pay it, it updates Xero, the accounting software, and then there's the accounts payable. This is a very, very normal flow chart of process for service-based businesses, right? So we have something similar to this, just a bit different. The client's name was Shane, which was the project manager's name was Shane, and they approved it. Okay, so why we drew this up was because for some weird reason the client never has struggled to get the money, and there was no profit at the end of the day. And we found out there was issues with this part here and variations. We found out that a lot of the jobs had variations, but the contractor or the employee was not sending out variations to make changes and to resend a new purchase order. So there was all these changes that were being made throughout this whole process in terms of like the job itself, and they weren't billing for it. So we had to fix this part up. We had to fix up the bottleneck in this section here where there was not enough variations getting sent. So we had to train the team up, embrace educate the team on how to spot a variation and what you need to do when there's a variation on a job. What we also noticed is that there was actually no one doing this part, the accounts payable side and accounts receivable side. So they actually everything fell on this person here, and this person was supposed to be following up accounts payable, accounts receivable, and they just didn't do that job because their focus was, actually planning and project managing, and their focus was, hey, you hired me as a project manager. I'm not supposed to do all this admin side. So we found out that we actually needed someone to to not just approve the work, but also to review accounts payable and receivables and make sure that at the end of the month, we're actually physically getting paid and finding better ways to actually get paid and chasing clients. So what happened here is that this part here needed to be fixed. There needed to be someone chasing the clients. We revised this whole structure later on. The client did it themselves, where they built another structure on top where we had a accounts receivable, accounts payable person speaking to the clients and making sure the clients paid us on time, or if there was any conflict or issues with the payments, they resolved it for them. So they'll go back to the contractor or go back to the PM to manage that process. We found so many errors with their process, and we wouldn't have been able to do it if we didn't draw up this process flowchart. So it's really important to actually review your processes and systems. And it happens all the time. The biggest issue with small businesses and big businesses is that time is money. And if you don't streamline your operations to free up people's time and to make sure that you shorten the time of delivery in terms of payment, in terms of operations, or in terms of service to the client, that means that you won't get that money in your bank account earlier enough. And as a result, what happens is in this business, they had so much money in accounts receivable and so much money in accounts payable that had to pay to other contractors that the business is pretty much close to folded, and we were able to save this business back then. Okay, same thing applies to this business. So back in 2016, I drew up an income tax return process for all my team members. So income tax return, what the client does is they usually request for us to do a tax return, and we drew out like the whole process. Client contacts us, we prepare an engagement letter and then send them a proposal. Client signs it, then it goes to the client provides information. Is all the information received? So the accounting team looks at that. The accounts and admin team look if all the information has been received. If so, they pass it over to accountant. Accountant does the work. Any questions, it goes to the client. Client sends back the information, and then it goes through a review process. Client then we finish off the work. It gets reviewed by a manager, and then the manager sends it to accounts team. Accounts team sends it out to the client. Client signs it. Payment received, and then lodge the tax return. That's what happens, right? That's the normal process of doing a personal return. So we went through this whole process, and then we realized that there was a bottleneck, and the bottleneck fell on this part here. We had so many jobs sitting in 10 to 20 days in review because we didn't have enough managers reviewing the work. And on top of that, that's what my manager said. They said, hire another manager because we need more managers. And I said, I don't think that's the problem. I think the problem is that we're taking too long to review a job. And I found out while talking to my team members is that they were actually redoing what the accountants were doing. The accountants would get all the information from the client, review all the information, put it into a spreadsheet, and then put that information to the tax return, do some planning, and try to minimize the tax as much as possible. And then they'll submit it for review. What the managers also did was then look at all the information was provided, analyze all the figures, then check every single transaction line by line to see if it matches, and then do the tax planning, and then send it out to the client. So they checked it line by line. And I was like, that's not how you review a job. And they were like, what do you mean? That's how we used to do it from back then. And I said, that's how you do it when you were an accountant. But you're not an accountant anymore. You're a manager. What managers are supposed to do is check for risk, like mistakes, check for risk. Is there a possibility that we've done the job wrong? does it make sense? Does everything look right? If it does look right, then you can pass it through. Your job isn't to redo the job. So they were actually spending double the amount of time that they should be doing because they were redoing the whole job itself. And I wouldn't have known that if I didn't draw this out and then have meetings with the team to work out where the bottleneck is. And one last thing is that I actually managed the process through a task management tool that gave me that information to work out that this is where the problem was. So I saw that the task was sitting with reviews for more than 10 plus days. And the only way I could figure that out is by monitoring the process through a project management tool. And at that time, I was using a tool called Asana, but now we use something called ClickUp. So every business has a different type of tool to project manage their work. So you got to just figure out which tool that you use to project manage your work. And from then, I was able to figure out that my managers were the problem. And once I started teaching them and training them how to review a job, they said to me, oh, no one told me this. If I did it like this way, it's a lot more faster. And so therefore, the result was not hire another employee, not hire another manager. It's actually train the team to do better. One thing I also realized in business, this leads on to the other thing, is that you have to reduce unnecessary expenses. And I know as a business owner, it's a bit hard to do because you agreed on paying for these expenses and you're so busy on a day-to-day basis that you forget and you just don't have the time to shop around for better deals, but you have to look at it. So your job as a business owner or a director is to work on the business, not work in it. So what that means that you have to do is allow for time to shop around for better deals. You need to review your insurance. You need to review your expenses and bills that you have, like phone bills, software, and you need to change. If you don't allow time for that, then just go work for someone, because you're still trying to be a technician from what you were before. But as a business owner, you need to start thinking about being a business owner and a director. And a director and a business owner, the reason why they do well and run a business is because they need, their job is to actually bring all the resources together and make it work efficiently, which means that you have to review it on a regular basis. You can't just do it once when you first start the business and just forget about it. It doesn't work that way. So I have to review all my softwares on an annual basis. We have a strategy in place that we had a manager's planning day. We went through all the softwares that we're using, and you don't need to do it yourself. You can actually allocate the work to one of the admin people to do if you don't want to do it yourself. But you have to have a process in place to do that. So reviewing all the expenses is a really good idea. I had a client that I saved $3,000 a year by switching to a different payment processor. So for example, they were using a software to collect payments. And the payments, they charged them like 3-4% a year. And they didn't realize that what was happening was they were paying for the 3% of per year. So I just said to them, why are you guys paying for the credit card fees? Why don't you just on charge it to your clients? And they said, I didn't even know you could do that. And I said, just go speak to your payment processor to see if it's possible. So they didn't do anything different. All they just did is spoke to the payment processor, which was, say, Stripe or whoever it was. And they realized that they can actually on charge the 3% to the clients. They made an extra $3,000 just by doing that. But if you don't do that and all your focus is just trying to work in the business, you're not being able to reduce your overheads. And as a result, it would just cost you more money. So cutting costs is like patching a hole with a leaky bucket. So sometimes you don't need to replace the bucket. All you need to do is just patch it. Yeah. You don't always need more money or more water. You just need less of it to leak out of the bucket. That's all. Yeah, cool. So with my business, the funny thing about this individual tax return process is we actually stopped providing, and I said this at the very start, we stopped providing individual tax returns to our clients. And the reasoning behind it is that we realized that the cost to actually do this job, we spent 2 to 3 hours on new clients to bring them in, engage them, and send a proposal out to them, then have a meeting with them to go over what we could do for them, and then wait for them to send the information over, then spend 1 to 2 hours to do the work, and then send it back out to the client. Wait for the client to sign, send out the invoice. It just took like 3 to 4 hours to all together for our admin team and accounts team to do the work, accountants. And we realized that we weren't actually making any money on this. So we actually stopped providing the service to our clients. Not like for businesses, but for individual standalone tax returns. And what we realized, and I can't really show you guys the numbers, is that we made the same amount of income from personal tax returns last year compared to this year, even though we stopped providing that service to the public. So all our business clients were still were basically funding. What it told us was that all our business clients was funding for standalone personal tax returns. We were making losses on our personal tax returns. And by stopping providing that service, we actually freed up a lot more time to actually focus on our business clients. And they helped us grow that side of the income, even though we stopped providing it to, the clients. Pretty crazy story in that part. That it changed everything for us. And then we realized one big thing about our business is that you should focus on high impact activities. So the 80-20 rule is what I learned, is that not all products and services and customers are created equal. So as your business grows, you need to work out which product or service that you're providing to your customers makes you more money, is more efficient, and you're better at it. So what we realized is that we're better at providing a service to our business clients and helping them grow their wealth, and then providing structures and planning for the future. So personal tax returns and standalone individuals, it had to go. So we realized those customers were just costing us a lot more time, and the services that we were providing to them were just wasting our time. And I'm not saying that it's like a bad product or all. Like, I'm sure there's people out there that are doing a really good job and making a lot more money on it. It's just not a product for us. So we just stopped providing it. So often 80% of the revenue or profits that you make in a business, and because I'm an accountant, I know this and I've seen the numbers. Yeah, so often 80% of the revenue or profit comes from the top 20% of your customers or products. So what you should do is analyze your margins by service, product line, or client, and you might find that you're working just as hard for much less return in some areas. So what you need to do is consider dropping the low margin services, increasing your prices on things that you're undercharging. And if certain clients are draining your time without delivering value, you may need to reset that and reset the boundaries, or even just consider letting them go or changing your business model completely. Cool. And that leads me to the third strategy, which is pricing. So pricing, I don't have any things to show you guys, unfortunately, but you'll notice that my website pricing has changed in the last 5 years. When I first built this model, I only had 3 pricing packages. Those 3 pricing packages was contractor, small business, and premium. But now, when you look at my pricing strategy, I've got these ones, and like different turnovers. So over time, I've evolved. And one thing I also did just recently was you would see that booking appointments, priority appointments, so if most of you guys would have booked online to see me, have you guys noticed that there's a difference of what's happening right now? Back then, when you booked with me, everything was free. So first initial consulting meeting was free. Right now, we're charging for it because it's taking too much of our time, and the demand is just there for us to pay for our services. We still do offer free accounting pricing, but here's the trick. If you, and I haven't fixed this yet, I only just changed this model just recently. But if you're trying to book, it's very hard for you to book with the free consultations because we're focusing on priority clients more. People that are willing to pay, people that have the right behaviors and personalities, that they understand that they value our services and they value paying for our services rather than the ones that just want a free advice. Yeah. So we used to do this because we went, even though that client isn't the right client for us right now, they may be a right client for us 6 to 12 months down the track. But we realize that we just don't have the resources to service all clients. And as a result, when some new person that comes on board, and we could have Mr. John Smith that books in a meeting, and I've seen this happen. I feel so bad about this. I see Mr. John Smith book in an appointment with me, and that appointment they booked in is like for 3 weeks later. And the issue is that Mr. John Smith is a high value client. And I know that because I can see his Instagram and he's got 1 million followers and he's like a business that has multiple businesses in his, under his name. And he's doing really well for himself. I can see that he's like a well-seasoned business owner. And what he wants is, he doesn't mind paying me, but he just can't book in a meeting because I've got 2 weeks of bookings that are all for free clients that are just getting advice from me for free. And he can't actually book in a meeting. He can't wait 3 weeks. So he was happy to pay me $490, but he just couldn't book in a meeting because there was no function that allowed me. So what I did was I changed everything. I changed my pricing. I said that moving forward, priority appointments, if you click on one of these, you can book in a meeting in the next 2 to 3 days. It hasn't happened yet because I'm still building this, but in the next 2 to 3 days, you can basically book in a meeting as long as you pay. But if you want a meeting with Davie Mack, it's $395 because you can go directly with the director. And we didn't allow for this before at the start because we just went free consultation for everyone. And I realized that we were losing clients as a result of that because clients care more about value rather than the services. Yeah. And you can see the differences of our pricing. If you look at our booking, basically booking platform as well, we've changed the pricing as well. And we were losing so many good clients that want to book in a meeting with us. But the problem with them is that they were so high value and they didn't have the time to wait 3 weeks. They wanted the answer straight away that they went to another accountant as a result. And so we lost that client. So, and they were willing to pay $400 for, a consultation. And you'll notice that the way we worded our services is that you can book a 30-minute one-on-one session with us. And the upfront payment that you make for the appointment can be credited towards your package, which basically means it's the same product that they're selling. It's just that they're putting the money where their mouth is, basically. So if they book in an appointment with us and they become a client, really they're paying the same value anyway. It's just that they get priority over the ones that just want free advice. We're still providing the free advice to the clients or for the leads because generally maybe they will become a client one day, just not yet because they didn't generate the income. But we've decided that we need to prioritize the clients that are willing to pay and willing to have a meeting with us to sign a proposal straight away. Yeah. So very different from how we used to structure our business. And we only learned that from just the mistakes we made. We had a lot, literally Mr. John Smith complained to us. I met him I was like, hey man, I just wanted to let you, I met him at a networking event and I just said to him, his name's not John Smith, I'm just saying his name's John Smith. But basically I met John Smith and I said to him, hey man, I saw you book in a meeting, but you canceled. And he's like, yeah, Davie, I love what you post online. I love your content. I learned so much from you. But the problem is I wanted to book in a meeting and I needed the answer straight away. And I was looking for an accountant and I just couldn't wait 3 weeks for you. So I found someone else. It was referred by someone else. And I think that what you need to do is fix up your appointment system. You should charge for your time. And I spoke to my team about that, about charging. They said, look, Davie, you shouldn't charge. If we charge for every single person, our leads would halve. So I don't think we should start charging. So we sat on it for 12 months. And then I realized, wait a minute, I could just charge for priority appointments and then not charge for others. Yeah. So anyway, that's just a business case for my business. The main goal, what I need you guys to understand is that you need to implement a value-based pricing rather than just following what your competitors do. So value means that for the clients that want more value or willing to pay for the value, you should charge for that price, the value that you're providing. So if your service, for example, saves a client $10,000, why are you only charging $500 for a job? That's not how you do value-based pricing. Value-based pricing is, if you're going to save the client $10,000, you should charge 20-30% of that, which could be $2,000, $3,000, because it not just saves the client a lot more time, but it saves them the efforts and the headspace, and it's worth it. Why do people pay for buyer's agents to buy property? You can go out there and buy your own property. There's no problems with it. It's just that people don't have the time to do it, and you're saving them time. So they can make a lot more money on their hourly charge or hourly rate when they run their own business. And so they're willing to pay $10,000 to $15,000 to find the right product, which is a property for them to invest in. And that's how buyer's agents have one of the best models out there in the world, okay? Because they found the right price for the right customer, and it's all about value basing on that product. The property that you're buying is $1 million purchase. So this could be like a lifetime asset that you're buying, that you will hold for 10, 15, 20, maybe even 40 years. So therefore, paying $10,000, $15,000 for a buyer's agent to find that property for you, what is $10,000 for 20 years of holding a property? And that 20 years, that property can go up like 5 times. Sorry, not 5 times, say 3 times. So for them, $10,000, $15,000 is not that much money at all. Yeah. And if you saw my website, from 2019, you'll notice that the pricing has changed as well. So my pricing has changed significantly over there since then. I think I was charging $180 for my basic charge, but now and my most premium price was $300. Now it's gone to $385. So inflation has been like 3 to 8% in the last 8 years. If your pricing stays the same for the last 5 years, you're actually losing money. And the reason being why you're losing money is not just because of rising costs. It's because your wages and your employees will demand a higher amount of wages. And if they don't find a growth from your company, they'll leave. So you're doing your team a disservice if you're not trying to grow the business in terms of the pricing increases. Because over time, your team members are going to get better. They're going to be able to provide a better service. Not just your team, even yourself. You as a person and your business owner, you're evolving over time as well. And so you should understand that the jobs that you're doing are probably taking less time because you're getting better at it from your expertise. So you should actually raise your prices. If you don't raise your prices and you keep it the same way, that means that you're less likely being able to increase your salaries for your team members. And the result is you're going to lose your key members. And it's happening already, like with our company. We had one person start with us on, say, $50,000, $60,000 as a junior accountant. 5 years later, their income is more than doubled. Yeah, doubled. If I kept my prices the same way, even though that person's providing a lot more value, that person's going to go elsewhere. That junior accountant, not a junior anymore, said, Davie, I love what you do. Thank you very much for the last 3 years or 4 years, but I need to look after my family. I need to buy a house, and the income that you're paying me right now isn't enough. And the result is that you spent 3-4 years helping this person grow, and then for them to go somewhere else to find a higher income or salary. And that's the biggest issue if you don't increase your prices slowly. If you increase it over time, you will then be able to keep the team that you have. And the funny thing is, I actually talked to my team about this in the manager's planning day. And I said, guys, you need to motivate the team members to ask for pay rises. Because if you don't talk to your team members about pay rises, then I can't work out in the next 12 months what our pricing should be. And if we need to increase our prices, because they need to tell us how much they want in the next year or 2 years. So I can just plan how much we're going to make for the whole year so I can afford it. Because if the salary increases eats up my profit, then I shouldn't be in business at all. Yeah, so that's Like it's just a whole like cycle that you have to go through, that increasing prices to make sure that you can pay for the expenses, and also make sure that you can retain the best team members in your team. That's the main reason people leave. They leave because of salary. Okay, the last thing I want to tell you guys is also anchoring. We anchor our pricing. So most clients don't actually jump on this $600 fee and want all the services. So but we do tell our clients that, the $2 million client is on a $600 meeting. Some of them want this. They want the full service where it's like quarterly meetings, tax planning, unlimited phone call support. They want the whole lot. They don't want to do anything. They want us to do everything. And then the bookkeeping of $600. So they're paying us like $1,200 a month for everything to be done. Sorry, sometimes it's actually $1,000. So it's like about $2,000 a month for us to do everything for it. And that's a lot of money. That's like $25,000. But we've anchored it, knowing that eventually the client now, if you ever grow your business, you know that your prices will increase. So let's just say that you're on 0 to 500K turnover right now. You're a startup business. You know your pricing is going to be maxed out at $385. But once you tick over and your business grows in the next 2 to 3 years and it doubles in size, one day I'm going to come calling and tell you that the price is going to change. Okay, I've anchored the price from the very start of our business relationship, and that's really important as a business. And the person that does this really, like the software business that does this really well, and I learned this from HubSpot. So HubSpot pricing, they do it even better than me, and I think it's a bit sneaky what they do, so I don't really like them that much. But they don't actually offer they do offer the pricing. They start it always at starting price. But the big difference what they do is that they provide discounts. So this is like a high price for the services that they provide. They usually do things for free for you. And then they get you into the system. And then what they do is they tell you that this is how much it is for like 5 seats. But you don't need 5 seats right now. You only just need 1 seat. And so you can't even really see 1 seat anywhere. Or you can actually see 1 seat is always $0. So they've anchored it really, really well on me. For example, I use HubSpot for our software. And then they've segregated every single service or every single product has another fee. So the more you grow, the more you need the services, the more they have to pay, rather than it's just like 1 set fee always. So I've kind of done the same with my business, probably not as good as theirs, but I still tried the same thing. So I've said to the team members that like every different type of service that you grow, or every type of service that the client needs, they won't need it now. They won't need bookkeeping. They don't have any bucket companies. They don't have any investments, but eventually they will. And here's all the prices there. Yeah. So we're initially, like I said, when I first had my business, there was only 3 models, three packages, basic, contractor, and then premium or small business. And that were the 3 I was selling. And then I realized, holy crap, like I need to anchor my prices and tell people what it should be when they grow their business. And so, it's easier for me to tell them now that the pricing is going to change because your business is growing, and they're more likely happy to pay for it. Yeah. Yeah. And that's it. That's the difference in pricing. Obviously, increase the prices as you can. Make sure you provide a value. And don't always just copy what your competitors are charging, because your competitors might be crap, like in the sense of like they're not doing the right services or review process, or their process of providing the value to the customer isn't good. Okay, I'll give you a really good example of a industry that the prices vary so much. So I had like my brother-in-law and sister-in-law that were building their house, and they said that they got quotes from $1 million to build a house to 1.8 mil. And they were just so gobsmacked why the pricing is so different. So 1 mil to 1.8 mil. And they chose the one right in the middle. So they didn't choose the $1 million one. They chose like 1.5 mil. Why did they choose 1.5 compared to 1.8 and 1 mil? Because the 1 mil, that if they chose the 1 mil person that provided the quote, it looked like a dodgy builder. The reviews online wasn't that great. They didn't look like they were actually completing the jobs. They did some search online and they didn't even actually have the licenses that they said they did. And the 1.8 mil, they looked at them. They also had some issues with them, but the main thing is that the price was over the budget, like it was just way too overpriced. And the 1.5, they looked at the business, and they looked at how long they've been around for, and the buildings they've actually built. They went over and checked it out. They realized that they delivered the starting build time of a past project was done a lot faster than all of the other competitors. So they realized that it's not, they rather pay like, extra 300-400K on top of what they budgeted for someone to deliver the product on the time that they want it to be delivered. So that's the difference. That value-based pricing is really important. Some people would rather pay more, even though it's quite the same product, because the product will be delivered faster and it will save the customer or the client a lot more time. So value-based pricing, make sure that you price your pricing right and increase it over time. And the last thing is anchor your pricing. Just make sure that you show to your clients that, yes, your pricing is this, but over time it may increase depending on the products and services that you want when your business grows. But yeah, anyway, guys, have a really good weekend, and I will see you guys next time.